For most American investors, access to international markets comes through exchange-traded funds. Saudi Arabia is no exception. ETFs are the primary vehicle through which U.S. investors gain exposure to Saudi equities. This video provides a detailed explanation of how Saudi Arabia ETFs work, what they are designed to track, and how professional investors evaluate these funds when considering Saudi market exposure. Because direct ownership of Saudi stocks is limited for U.S. retail investors, ETFs serve as an access layer between American capital markets and Saudi equities. These funds are listed on U.S. exchanges, trade during normal market hours, and hold baskets of Saudi companies selected according to defined index methodologies. When an investor purchases a Saudi-focused ETF, they are not buying individual Saudi stocks directly. Instead, they are buying shares in a fund that already owns those companies. This structure simplifies custody, settlement, tax reporting, and operational complexity. Professional investors begin by understanding exactly what an ETF is designed to track. This includes identifying the underlying index, the eligibility criteria for inclusion, and the weighting methodology used to allocate capital across holdings. Some Saudi ETFs are designed to track broad market exposure, while others focus on large cap or liquid segments of the market. Understanding these distinctions is critical because different index designs produce different risk and return profiles. Sector exposure is one of the first characteristics evaluated. Saudi ETFs often have meaningful allocations to energy, banking, telecommunications, and infrastructure-related companies. Professionals assess whether this sector mix complements or overlaps with existing portfolio holdings. Energy exposure, in particular, requires careful consideration. Because Saudi Arabia plays a central role in global energy markets, energy companies can represent a significant portion of ETF holdings. This increases sensitivity to oil prices and global energy demand. Financial institutions represent another key component. Saudi banks often operate within a well-capitalized system and can contribute both stability and income. Telecommunications and infrastructure companies may provide recurring revenue characteristics. Expense ratios are another important evaluation factor. While ETF fees may appear modest, they compound over time and can materially affect long-term returns. Professional investors compare expense ratios relative to exposure quality, liquidity, and tracking accuracy. Liquidity is evaluated at both the ETF level and the underlying market level. While Saudi ETFs trade on U.S. exchanges and offer daily liquidity, trading volume and bid-ask spreads can vary meaningfully between funds. During periods of market stress, liquidity conditions can change. Professionals consider how easily positions can be entered or exited without materially impacting price. Dividend treatment is another practical consideration. Dividends paid by underlying Saudi companies are collected by the ETF and distributed to shareholders according to the fund's schedule. Distribution frequency and variability depend on sector composition and corporate payout policies. Dividend yields may fluctuate over time, particularly in energy-weighted funds where payouts are influenced by commodity cycles. Professionals evaluate dividend sustainability rather than headline yield levels. Currency structure is often misunderstood. Although Saudi stocks are denominated in rials, the rial is pegged to the US dollar. This reduces currency volatility for American investors compared to many other emerging market ETFs. However, reduced currency volatility also limits currency-driven upside. Professionals view this as a trade-off between stability and potential return enhancement. Tracking error is another factor evaluated carefully. No ETF perfectly matches its index. Differences in timing, liquidity, cash holdings, and expenses can cause performance deviations over time. Professional investors review historical tracking error to assess how consistently the ETF has followed its benchmark and whether deviations are acceptable given the exposure provided. Another consideration is market accessibility. ETFs provide exposure without requiring investors to navigate foreign brokerage accounts, local regulations, or cross-border settlement processes. This accessibility is a key advantage for U.S. investors. Risk behavior across market cycles is also analyzed. Professionals assess how Saudi ETFs have behaved during periods of energy price volatility, global equity sell-offs, and risk-off environments. Understanding performance during stress periods provides insight into how the ETF may behave as part of a broader portfolio. Importantly, ETFs are tools rather than strategies. Professional investors do not purchase ETFs in isolation. They use them to express allocation decisions, manage diversification, or gain targeted exposure within a defined portfolio framework. Position sizing is critical. Saudi ETFs are typically used as a component of a broader international or emerging market allocation rather than as a standalone investment. Exposure is sized conservatively to manage volatility and country-specific risk. Rebalancing discipline plays an important role. As Saudi ETFs outperform or underperform relative to other assets, allocations are adjusted to maintain target portfolio weights. Professional investors focus on process rather than prediction. Rather than attempting to time entry points precisely, they emphasize diversification, cost control, and disciplined rebalancing. Another important factor is correlation. Professionals evaluate how Saudi ETFs move relative to other portfolio holdings. Assets that exhibit different behavior under various market conditions can improve overall portfolio resilience. Saudi ETFs may offer diversification benefits due to their unique economic structure and sector composition. However, these benefits are evaluated empirically rather than assumed. From a long-term perspective, Saudi ETFs are viewed as a means of participating in structural economic trends, income generation, and geographic diversification. They are not designed for short-term speculation. For American investors, the key takeaway is that Saudi ETFs provide a regulated and accessible way to gain market exposure, but they require careful evaluation. Understanding what the fund holds, how it behaves, and how it fits within a portfolio is more important than short-term performance. This disciplined approach reflects how professional investors use ETFs across all asset classes. The focus is not on finding the perfect fund, but on selecting appropriate tools that align with long-term objectives. This content is provided for educational purposes only and does not constitute financial advice. For a structured overview of Saudi ETFs, risks, dividends, and portfolio positioning, download the full Saudi market guide linked in the description.